The analysis argues that beneath the appearance of stability, the US economy has become structurally fragile, built on debt, fiat money, and asset inflation rather than real production. Since abandoning hard monetary anchors, institutions have preserved the illusion of security by suppressing interest rates, rewarding asset owners while trapping savers in declining purchasing power. Cash, once a safeguard, now steadily erodes under rising costs of housing, energy, healthcare, and education. As public debt crosses historic thresholds, individuals can no longer rely on state-backed stability. The documentary contrasts two paths: remaining loyal to paper promises and centralized systems, or building resilience through hard assets, pricing power, and adaptable skills. Ultimately, it reframes wealth not as numerical growth, but as real-world control over resources, arguing that survival in a fragile system requires thinking like a sovereign risk manager rather than a passive saver. Chapter 1: The Anatomy of Fragility. You've done everything right. You went to school, you got the job, you put 10% into your 401 KEK, and you keep a tidy sum in a high-yield savings account. On paper, you are the model citizen of the financial system. But late at night, when you look at the price of a starter home, the cost of health insurance, or the grocery bill that seems to jump every 3 weeks, you feel a sense of vertigo. It's the feeling that the ground beneath you isn't stone. It's a thin layer of plywood over a canyon of debt. Our global financial system is not built on production. It is built on credit. Since 1971, the world has operated on a pure fiat standard. This means money is no longer a store of value protected by a physical commodity. It is a utility whose supply can be expanded at the whim of central banks. In a fragile system, the primary goal of the institutions is to maintain the illusion of stability. They do this by suppressing interest rates and inflating asset prices. This creates a wealth effect for those who already own assets, but it creates a poverty trap for those trying to build wealth from zero. When you perform an autopsy on an empire, you always look at the debt. Historically, when a nation's debt to GDP ratio crosses the 120% mark, the outcome is mathematically binary. Either they default on their promises, or they inflate the currency so much that the promises become worthless. In 2026, we are past that horizon. The fiscal foundation of the state is cracked. This is why your personal foundation cannot rely on the state's stability. Building wealth in a fragile system requires you to stop thinking like a saver and start thinking like a sovereign risk manager. Chapter 2: The Savings Autopsy: Why Cash is a Liability. The 2% lie versus the real cost of living. The system tells you to save cash. Your bank app gives you a little gold star when your balance grows. But Joe has a rule. In a fragile system, cash is not an asset. It is a melting ice cube. We are told lamb fat is 2%, but the fiscal foundation of the average family is built on 3 pillars: shelter, energy, and education. If you look at the forensic data of the last 20 years, these 3 categories haven't risen by 2%, they've risen by 6% to 10% annually. If your high-yield savings account pays you 4.5%, while the real cost of survival rises by 8%, you are not building wealth. You are paying a 3.5% annual penalty for being responsible. The bank takes your cash, lends it out at a higher rate, and gives you back rewards points that won't even buy you a tank of gas in 5 years. The liquidity trap. The catch with cash is that it feels safe because the number doesn't change. But nominal stability is the predator's favorite camouflage. A $100 bill in 2020 bought a full cart of groceries. In 2026, that same $100 buys 3 bags and a sense of regret. The number on the bill is the same, but the energy it represents has evaporated. To build a real foundation, you must move from nominal wealth, the number of digits, to real wealth, the ability to command resources. Chapter 3: The Architecture of the Fortress: Tangible Assets and the Power of Valuation. In a fragile system, the only way to protect your foundation is to anchor it to things that cannot be created with a click of a mouse. If a central bank can print $1 trillion in a weekend, that $1 trillion has no effort behind it. However, your wealth represents your lifetime's effort. Why would you trade your lifetime's effort for something created out of thin air? 3 pillars of a solid foundation. Productive land. Not just a suburban lawn, but land that produces calories or shelter. This is the ultimate floor. Whatever happens to the dollar or the euro, people will always need to eat and sleep. Intellectual and technical capital. In a system where currency depreciates, your earning potential is your best hedge. If you possess an essential skill, whether it's advanced programming, surgical expertise, or specialized trade skills, you can reset your price each morning to match inflation. Invest in stocks of companies with pricing power. You want to own businesses that not only survive inflation, but also profit from it. These are companies that can increase their prices by 10% because their customers have no other choice. Think of utilities, essential infrastructure, and dominant technology platforms. Chapter 4, the psychology of the fragile, avoiding the herd trap. Why do most people stay in the fragile system until it's too late? Because of recency bias. They assume that because the bank was open yesterday and the dollar bought bread last week, it will always be so. The catch is that fragile systems don't break linearly, they break exponentially. Think of a bridge that is rusting. For 50 years, it holds the weight of the cars. It looks stable, but the rust is performing a silent autopsy on the structural integrity. One day, a single truck drives over it. A truck no heavier than the thousands that came before, and the whole thing collapses. To build wealth, you must be the person who sees the rust while everyone else is looking at the view. You must be willing to look wrong for a long time so that you can be safe when it matters. This means diversifying jurisdictionally, holding assets in different countries and digitally, using decentralized systems that don't rely on a single central bank. Chapter 5, the sovereign exit, Alex versus Jordan, a tale of 2 foundations. Let's look at the final forensic comparison. Alex, the system loyalist. Alex keeps his wealth in a 401k and a local bank. He owns a house with a 90% mortgage. When the fragile system experiences a liquidity event, a banking holiday, or a massive currency devaluation, Alex is trapped. His house is illiquid, his bank is closed, and his 401k is a digital entry he cannot access. Alex's foundation was never his, it was rented from the system. Jordan, the sovereign builder. Jordan has a floor of physical gold and decentralized assets. He owns a small, productive property outright. He has invested heavily in his own specialized skills. When the crisis hits, Jordan doesn't panic. He has a self-directed perimeter. His wealth isn't a claim on a bankrupt state. It is a claim on real-world utility. The final word. Building wealth in a fragile system isn't about being rich. It's about being resilient. The system will continue to offer you easy paths, low interest debt, shiny credit cards, and paper promises. But there is always a catch. The easy path leads to the center of the fragility. The hard path, saving in hard assets, learning difficult skills, and ignoring the herd, is the only one that leads to a foundation that can survive the autopsy of the next century. The system is fragile. Your foundation doesn't have to be.